what our results show is that best-in-class companies have a direct correlation in terms of their outperforming their competition in really managing the inventory cycles in a way that they're able to move inventory faster in their stores. They're also in a better position, twice as likely to be in a better position to outperform the average and laggard retailers in terms of really ensuring that they do not mark down excessively. And what does that mean? Just to give you a sense, in the first quarter of 2009, our results showed from all the surveys that we had conducted that retailers marked down in order to get over the holiday hump. They had to mark down their excess holiday merchandise to the tune of 30% or more of their entire merchandise set, and that obviously impacted the bottom line. Now, best-in-class companies are twice as likely of not doing that. And what our results also show, interestingly enough, is that best-in-class companies are 5 times less likely to be underperforming in terms of their inventory results compared to average and laggard companies. So that's clearly stating that that there is a direct correlation between best-in-class retail performance and inventory excellence. And I think that really needs to be a benchmark for average and laggard companies on how they can improve. And in the following slides, we'll be talking about how companies can actually improve. So the next slide is a fairly interesting overarching viewpoint where you think about the retail C-level executive, the VP of supply chain, the VP of inventory management, the VP of distribution. These are the job roles that really manage the overall strategy and execution related, the tactical campaigns that are related with precision inventory and merchandising strategies in retail today. Now, when these job roles and these executives are sitting on a day-to-day basis in their boardrooms and having conversations on how they can improve their merchandise turn cycles, how can they improve the GM ROI, how can they improve the days of inventory, having less inventory in their stores and in their warehouses and be able to move the inventory much faster, so the sell-through rate. There are certain business challenges that are facing them. And on the other hand, you can see on the screen there are some technology priorities that convert from the business challenges. So first and foremost is the pressure to improve sales channel service levels or product availability. Now, the most important aspect related to the business challenge around inventory management is how do companies really improve sales channel service levels, and that really goes down to the shelf level product availability. Now, this is the number one pressure today, is how do you ensure optimized product availability at the shelf when the demand is shifting as consistently as it has been on a week-to-week basis. I just had a conversation with a large fashion apparel brand in the U.S., and they informed me that it's tough for them to plan their assortment sets compared to the based on the historical data, because the demand has shifted so much. Some of their core segments have actually shifted. So they had a core segment, the tween segment, which is now leading the way in terms of being a top 20% revenue generator for them, whereas the teen segment is no longer a core segment for them, at least as far as their Q1 results go. So the pressure to improve sales and channel service levels is extremely important in retail. The second highest pressure, or the business challenge, is when companies think about the need to improve inventory performance, it's extremely important to reduce the high inventory carrying costs. Because what that does is it really opens up the gateway towards improving working capital optimization. The third business challenge with these inventory honchos are facing on a day-to-day basis, those that are planning merchandising strategies, those that are planning assortment sets and clusters and the size, colors, and different assortment variables, is the inability to accurately forecast inventory requirements. And this is a point that I've been making all along, is there a way that retailers have the most efficient way of forecasting? Do they have advanced forecasting tools? Do they have tools that can help them with what-if scenarios in case the demand is shifting? So do they have a demand-based inventory or a demand-responsive inventory management system, or do they have a legacy inventory management system which has been typically based on traditional inventory strategies such as static inventory, the lack of tools, the lack of visibility, and more of the greenfield inventory systems that have existed in the industry in the past? Now, in terms of how these challenges are converting into technology priorities, what Aberdeen has found is that inventory forecasting systems rate number one and top of mind in terms of the top executives that we've surveyed. Multi-user and location-based software applications that deal with multiple warehouse systems, and those that are integrated, these inventory systems that are integrated with the ERP and POS systems are the next highest technology priority in terms of how companies are looking to improve. Demand responsive, distributed order management system that is really combined with the overall inventory infrastructure, inventory technology infrastructure, is the third highest technology priority today. So as you can see, the overall message coming out of this slide is that business challenges convert into technology priorities, and when business challenges do convert into technology priorities, there are a demand response based inventory management system is what is coming out on top, and it has to be multi-user, multi-enterprise, multi-location system that can really predict demand, that can highlight the gaps in the fill rate that is so important in retail today. Now let me talk, now that I've spoken about the business challenges and some of the pressures, let's talk about some of the core strategic actions that companies are taking. And this goes into Aberdeen's space model, and I'm going to talk about the number one strategic action that's being taken by retailers as they look at the inventory understock or overstock situations in their retail stores and how to solve that situation. So first and foremost, I think what almost half the companies, 48% of retailers that we surveyed, are trying to balance inventory carrying costs and working capital requirements. I think there's a direct relationship there where if the retailer is able to reduce their inventory carrying costs by really optimizing between the fast-moving goods and the slow-moving goods, and really having lean retail techniques in place so that they carry what they can sell and they don't have excess safety stock in the stores or buried in the warehouses, or for that matter, they do not have a large number of open-to-buy requirements. At the same time, they have high service levels. So obviously, you need to balance that strategy. Overall, I think if the retailers are able to reduce their inventory carrying costs year over year, they are in a much better situation to be positive on their working capital, and that working capital can be used for some customer-facing priorities that the retailer wants to take up. Because at the end of the day, if your working capital is freed up, you can focus on the customer and really do your job as a retailer in servicing the customer needs on a day-to-day basis. So that's the number one strategic action that is top of mind for retailers today. Now let me talk about some of the core capabilities as part of the PACE model. So we're discussing the C in the PACE model, and in this case I will talk about two core capabilities where best-in-class companies are outperforming average and laggard companies according to our data. First and foremost, best-in-class companies maintain updated records for inventory planning at the headquarters. What this really means is that best-in-class companies are moving away from the paper-based inventory record keeping processes. They're moving towards more automated processes, and they've automated the entire value chain in terms of how they keep inventory planning records. And what this really means is that anything related to open-to-buy requirements, order cycle times, purchase orders,